You know, when most investors look at a company, there's usually one number they check first, the PE ratio. And the thinking is pretty simple, right? Low PE means cheap, high PE means expensive. But what if I told you that two companies could have the exact same price and make the exact same profit, but one is an absolute money-printing machine and the other is just a capital-guzzling disaster? Well, today, we're diving into the one metric that can actually tell you the difference.
So let's just start with a simple question. If you have two businesses, they earn the exact same amount of profit, and their stocks are trading at the same valuation. Are they the same quality? The answer is not nearly as simple as it looks, and figuring it out is really the key to spotting truly great companies.
So picture this. You've got Company A and Company B. Both have a PE ratio of 15. I mean, on the surface, they look like twins from a valuation standpoint. But under the hood, the engine running one of these is just way more efficient than the other. The PE ratio, it just doesn't show you that.
And that, right there, is the crucial point. The PE ratio is a price tag. It just tells you what you're paying. But return on invested capital, or ROIC, that tells you about the quality of the business you're actually buying. It's the metric that really pulls back the curtain on a company's true money-making ability.
So here's our game plan. We're going to start by shattering that PE illusion with a simple story. Then, we'll dig into how to actually calculate this powerful metric, understand the true test of growth, and finally, learn how to separate the genuinely strong companies from the ones that just, look good on paper.
Okay, let's make this really easy to understand with a little story. Forget about Wall Street and complex formulas for just a minute. Let's talk about two guys who own hot pot restaurants. Meet Old Wang and Old Lee. They both have the exact same goal: open a restaurant, make some money. Simple enough, but they go about it in completely different ways. Old Wang is clever. He's super efficient. Old Lee, on the other hand, he's lavish. He thinks you gotta spend big to make big.
So Old Wang, our efficient guy, he gets his entire business up and running with just $100. He buys the essentials, a good pot, fresh ingredients, and he focuses only on what's going to make him money.
Old Lie, though, he goes all out. He rents the most expensive spot in town, buys fancy decorations, and invests a whopping $1,000 before he even serves a single customer. That is 10 times more capital than Old Wang.
Now here's the kicker. At the end of the year, after all the bills are paid, both Old Wang and Old Lee made the exact same profit, $20. If you were just looking at their income statements, their businesses would look pretty much identical.
And this is where it all comes together. Old Wang turned his $100 investment into $20 of profit. That's a fantastic 20% return. Old Lee needed $1,000 to make that same $20, giving him a measly 2% return. See the difference? In the business world, Old Wang is a genius, and Old Lee, well, he's a dud. This right here is the soul of ROIC.
All right, now that we get the idea intuitively, let's look at how you'd actually calculate this for a real company.
So, what is ROIC officially? Well, it measures how much profit a company is generating for every single dollar of capital that's been put into the business, and that's from both shareholders and lenders. It is the ultimate measure of a company's capital efficiency. The formula looks like this: NOPAT divided by invested capital. No, don't worry about the acronyms. This sounds scarier than they are. We're going to break down each part right now.
Let's start with the top number, NOPAT. That stands for net operating profit after tax. The key word to focus on here is operating. We use this instead of just regular old net income because we want to see how profitable the actual business is, before any financial wizardry. It strips out the effects of debt and interest payments to give us a pure, clean look at the business's core earning power.
Okay, now for the bottom number, invested capital. This is pretty much all the money the company has used to build its operations. It's the money from shareholders plus the money from lenders. But in this part is really important. We subtract any excess cash. Why? Because cash that's just sitting in a bank account isn't actually being used. It's not working for the business.
Let's walk through a super quick example. With a made-up company, we'll call it Amutech. First, we get NOPAT. We take their operating profit of $100 million and apply the tax rate, which gives us $75 million. Next, invested capital, $300 million in equity plus $200 million in debt minus $50 million in cash just sitting around. That gives us $450 million. Now, we just do this simple division.
And there you have it. Amutech's ROIC is 16.6%.
Now, this isn't just a random percentage. It's a measure of how powerful the company's economic engine is. So hold on to that 16.6% because what we do is it next is the most important part of this whole thing.
So having a number is great, but a number without context is pretty useless. And this is where we learn to separate true value-creating growth from the kind of growth that actually destroys a company from the inside out.
Here is the golden rule of value creation. A company's growth is only a good thing if its ROIC is higher than its WACC, which stands for weighted average cost of capital. Just think of WACC as the hurdle rate. It's the minimum return a company has to make to keep all of its investors happy, both the people who own its stock and the people who own its debt. If you're not clearing that hurdle, you are not creating value, period.
The concept is actually really simple. If a company's ROIC is greater than its WACC, it's a value creator. Every single dollar it reinvests in itself generates more than that dollar cost to get. It's a money printing machine. But if the ROIC is less than the WACC, it's a value destroyer. The faster a company like that grows, the faster it burns through cash. That's a fake growth company. Okay, so let's bring this all together. With this knowledge, you now have a brand new, powerful filter to tell the difference between companies that are genuinely strong and those that just look big and, well, kind of puffy.
So, to put it as simply as possible, the P/E ratio tells you how expensive a stock is. ROIC tells you how strong the underlying business is. The best investments are always strong businesses bought at a reasonable price, and you just can't know if a business is truly strong without looking at its capital efficiency.
All right, to recap our main points. First, don't be fooled by the P/E ratio on its own. Second, ROIC is the real measure of how good a company is at turning capital into actual profits. Third, a high ROIC is the hallmark of a great business. And remember, real value-creating growth only happens when that ROIC is higher than the cost of capital. A fast-growing company might just be puffy, not truly strong.
So I'll just leave you with this question. The next time you see a company with these incredible, soaring revenues, is your first question going to be about its price or about its fundamental strength? Shifting that one question is the first step toward becoming a much, much sharper investor. And just a quick reminder, all the analysis here is for educational purposes and is not investment advice. Please do your own research before making any decisions. Thanks for tuning in.